Okay, let's jump right in. You see a building, you think it's a building. I mean, simple enough, right? But in the world of accounting, the reason you own that building changes literally everything. The accounting for your own office is worlds apart from the accounting for a building you just own to collect rent. So the big question is, why isn't a building always just a building? Let's figure it out. Today, we are cracking the code on a topic that is a huge deal for your future CPA exams: investment property, or as you'll know it, IAS 40. I know this is one of those standards that can really mess with people's heads, but don't worry, we're going to break it all down so you can lock this knowledge in for the long run. We're going to do this in 4 quick acts. First up, Act 1, the identification. Before we do anything else, we have to know exactly what we're looking at. And trust me, this first step is absolutely critical. If you get the classification wrong here, the rest of your accounting for it will be a complete disaster. No pressure, though. So let's get the official textbook definition out of the way. IAS 40 says investment property is property, land or a building, held to earn rentals or for capital appreciation, which is just a fancy way of saying you're holding it for its price to go up, or, both. The keywords you got to burn into your brain are rentals and capital appreciation. Its entire job is to make money all by itself. Okay, let's translate that formal definition into stuff you'll actually see in problems. Just think of it like this. An investment property is the asset that works for you, not with you. It could be a piece of land you're just sitting on waiting for the value to pop. Oh, and here is a massive exam tip. If you own land and you haven't decided what to do with it yet, it's automatically classified as investment property. Or it could just be a building you lease out to tenants. It's all about that passive income or that long-term price jump. Look, knowing what it is only half the battle. We got to talk about what it is not, because this is where the exam traps are. Examiners love this stuff. So if you use a building for your own business, like your headquarters, nope, that's PPE under IAS 16. What if you're a developer building houses to sell? That's your inventory under IAS 2. And be so careful with leases. If you lease it out under a finance lease, that's a whole different set of rules. Knowing these differences is absolutely key. Okay, moving on to Act 2, the valuation. So you've correctly identified your investment property. Awesome. Now you have a huge choice to make. How are you going to measure this thing? And this isn't some tiny detail. It's a major policy choice that completely changes how your financial statements look. You basically come to a fork in the road. You can go with the cost model, or you can go with the fair value model. The cost model is going to feel really familiar. It's pretty much the same way you account for all your other PPE. The fair value model, though, that's a different beast entirely. It means you have to update the property's value to whatever it's worth on the market every single year. So if you pick the cost model, it's pretty straightforward. You book it at cost, you depreciate it, and you check for impairment. Easy. But, and this is a big but, there's a sneaky little detail you cannot forget. Even if you use the cost model, you still have to figure out its fair value and disclose that number in the notes. They love testing that. Now, let's talk about the fair value model. You still start by recording it at cost, but after day 1, everything changes. Every single year, you adjust its value to the current market price. And here's the real kicker. Any change, whether it's a gain or a loss, goes straight into your profit or loss. That can make your income statement look like a roller coaster. And this all leads us to the single most important rule you have to remember. This is it. This is the golden rule. You never, ever, ever depreciate an investment property if you're using the fair value model. Why? Because you're already updating it to market value every year. That fair value adjustment basically replaces depreciation. Seriously, if you remember only one thing from this whole explainer, make it this. I can almost promise you it'll be on your exam. All right, on to Act 3. Look, businesses change, strategies pivot, and sometimes the purpose of an asset changes right along with it. What happens when you don't need your head office anymore and you decide to rent it out? Or you finish building something and decide to just hold on to it and wait for the price to go up? That's what reclassification is all about. Now listen, the standard is super strict about this. You can't just reclassify a property because your boss has a new idea. There has to be an actual, real, evidence-backed change in use. So for example, you physically start renting out your old office building, that's a change. Just saying you plan to do it in the future, that's not good enough. Okay, this slide right here is pure study guide gold. Seriously, screenshot this. This little cheat sheet tells you exactly what to do when transfers happen under the fair value model. And pay close attention to how the treatments are different. See that? Transferring from PPE to investment property, that creates a revaluation surplus in OCI. But transferring from inventory, whoa, that difference goes straight to profit or loss. Know this table. It will save you. All right, Act 4. This is it. Your rapid-fire, high-impact review. We're going to take everything we just talked about and condense it into a brain dump of the absolute must-know facts for the LEPCA. This is the stuff you got to burn into your memory bank. Let's lock these in. Number 1, investment property makes money all on its own. 2, if you've got land with an undecided use, what is it? Investment property. That's a classic question. 3, transfers need a real change in use, not just a plan. And 4, even if you use the cost model, you still have to disclose the fair value. These are your moneymakers on the exam for sure. Okay, time for some active recall. This is a study hack that actually works. It forces your brain to retrieve info, not just recognize it. I'm going to ask you one more time to make sure this sticks. Under the fair value model, is investment property ever depreciated? That's it. The answer is a hard no. Never. The annual fair value adjustment makes depreciation completely unnecessary. Simple, powerful, and an easy point to score on the exam. And this quote right here, this really gets to the soul of the topic. Like, why do we even have a separate rule for this stuff? It's because an investment property is fundamentally different from your other assets. Your factory, which is PPE, needs people and machines to make money. An investment property, it just sits there collecting rent or appreciating. It's financially independent. If you get that core principle, you can reason your way through any weird scenario they throw at you. And let's end with a little something to take you to the next level. What about those mixed-use buildings? This is where it gets interesting. If you can sell the parts separately, you can actually account for them separately. If you can't, it all comes down to whether the part you use yourself is insignificant. This is how these rules play out in the messy real world, and it's a great place to keep digging deeper in your studies. You got this. Thanks for tuning in, and good luck with the review.